Welcome back to part 3 of our series on random forests. So in this series, we are creating a random forest model to help predict the direction of a stock price given some historical data and some historical technical indicator values. So in our previous portion of this series, we were basically understanding the data set that we were working with. We did some pre-processing steps. So just a simple calculated column, and then making sure that that calculated column was truly right. And so that meant adjusting some rows where the data was changing. Now that we kind of have our baseline, as we want to call it, we're going to get into the indicator calculation portion of this series. And so this entire video is dedicated to calculating the indicators. FYI, I will be taking some pre-existing code and copying it over. That's to save some time, also making sure I'm not doing any errors. But I do want to dedicate some time to, what kind of indicators they were using, kind of at least my interpretation as to why they were using those indicators, and kind of what the end goal of all this was. So again, if you read through the paper, you're going to notice something right away. When you get to the indicator section, you're like, oh, momentum indicator, momentum of price, momentum indicator, momentum indicator. They used basically a bunch of momentum indicators in this data set. So initially I was kind of perplexed by that, because I said, that's kind of interesting. Normally when I've seen people in the past, normally you want indicators that are kind of telling you different things. And I said, I wonder why they kind of approached it like that. And I kind of sat and I thought back a little bit. I said, well, if your only goal is to understand the direction and you're not trying to forecast price, it kind of makes sense why you would do a momentum indicator, right? Because momentum is basically just telling you kind of the speed of, and the direction of the trend, if you really think about it. And so really, if you're trying to verify that momentum or that direction of the price, I can kind of see why you might use multiple indicators that are measuring the same thing, because if each one is telling you the same exact thing, which is the momentum's increasing, or hey, we're heading this direction, that kind of makes sense then. So whatever direction we're going in, it seems like we're going to be continuing that direction. And so if say 4 out of 5 are telling you, hey, we're still heading in this direction, you can kind of use that group mentality, kind of like what random forest already does from the get-go, and say, hey, if 4 out of 5 are saying that we're heading this direction, we're probably heading that direction. And the idea is that each one of these momentum indicators is measuring momentum, but it's looking at it from a different perspective. And so at least the idea would be you're looking at it, you're getting the same thing, but you're measuring it different ways from different perspectives. And so if each one of them is kind of telling you the same thing, you would imagine that at least you're heading in that same direction. So again, I'm not saying these are the only indicators you have to use, and I'm not even saying these are the indicators you have to use. You could change them, but you just have to understand, again, you could get vastly different results than what you got from what this paper did. But that might work for you. Maybe you're not looking for the momentum, or maybe you're looking for something different. Then at that point, you might have indicators that you want to use from the get-go, and incorporate it somehow in your model. So this is just kind of give you some context and perspective about why I think at least this model was built the way it was built. Interpretation, opinions behind, on the side. Again, this is kind of the approach behind it. And I kind of liked it. I think it made sense once I kind of understood it, but it's not to say this is the only way of doing it. So now with that kind of context out of the way, I think the first thing we can do is we can calculate the relative strength index. And so I do have some definitions. I might be switching back and forth between the paper, but the RSI is a popular momentum indicator that determines whether the stock is overbought or oversold. A stock is said to be overbought when the demand unjustifiably pushes the price upwards. The condition is generally interpreted as a sign that the stock is overvalued. And then the price is likely to go down. A stock is said to be oversold when the price goes down sharply to a level below its true value. This is the result caused due to panic selling. The RSI ranges from 0 to 100, and generally when the RSI is above 70, it may indicate that the stock is overbought. And when the RSI is below 30, it might indicate that the stock is oversold. The formula is 100 plus 100 divided by 1 minus the relative strength. And the relative strength is, I believe, the average up over the average down divided by the average down. We're going to be using an exponential weighted moving average to calculate that. So first things first, I'm going to copy some code because where's the fun if you don't copy anything? And then we're going to walk through it. And on top of that, the code might change a little bit. I do like to show people sometimes multiple ways of doing things, and not to say it's horrible, but it's just sometimes you might want to do something a little bit differently. So in this particular example, you do have to specify the number of periods that you want to look back with the RSI. In the paper, they actually did specify they look 14 days back. There's one indicator where they do not specify how far they look back, so I kind of just use the standard one. That's the percentage change, but for their RSI indicator, they look back at the past 14 days. So the first thing that you need to understand, so I'm going to kind of copy this out, is I do make a copy of certain columns from my data frame. So the first thing I do is I take my price data frame and I select the columns I want. So in this case, I want the symbol and change in price, and then the symbol and the change in price. And then I call the copy method. I separate it by a comma because I'm specifying that I'm going to be doing this twice and assigning it to each one of these variables. Again, technically, you probably could have just done it one time and then adjusted X, Y, Z. But for our purposes, let's just try to make it as clear as possible and make sure you understand kind of what's going on. So if I just show you what it looks like, you will see it's just those two columns. So at this point, we have copied those columns twice. Now, once we've done that, the first thing I need to do is I need to identify the days that were the up days. And so the rule is very simple. We're going to take our up DF, and for the rows where the change in price is less than 0, I'm going to change the change in price column to 0. So basically this column will only contain positive values, or sorry, not always, because the other one does do technically, but it's only going to contain the rows where the price moved up. If it didn't move up, it's just going to be 0. So this is important because, again, the RSI indicator does require the change in price, so it needs the average up and average down. So we have to first identify over the last 14 days how many times did it go up and stuff like that. So if I look at it now, I should see this extra column. And you can see that it's changed a little bit, and it's now 0 sometimes, or it's the actual positive value. So if it moved up, it moved up. And you can see that certain days it moved down multiple days in a row. Other days it moved multiple days it moved up. So all this was doing was making sure that if it moved up, it kept the value. If it moved down, it set that value equal to 0. Now, for the down days, it's the same thing, just opposite. So now what I'm going to say is, okay, for my down DF, if the price is greater than 0, those were up days. So I want to change that change in price column to 0. So if it was an up day, make it 0. Otherwise, keep it the same. Now, the RS formula, so the relative strength formula, does expect absolute values, so you cannot pass through negatives. So once I've done that, so once I've identified the rows where the price dropped, I need to make sure that I take that change in price and I wrap it in an absolute value. So that means if it's negative, it will now be positive. Again, the reason I'm doing that is it's because this formula does expect positive values. It does not expect negative values. And so you can see here, again, these are different prices. Actually, what I'll do is kind of, to make it a little bit more interesting, hopefully you'll kind of see it like this. You'll see that now it's actually negative, right? So it's negative, it can't be negative. I need it to be positive. So what I do next is I now flip the sign. So now everything is correctly done. So that's pretty good. From here, what I'm going to do is I'm going to calculate my EWMA. So the relative strength formula, for this one, what we have to do is we have to calculate the exponential weighted moving average for the last 14 days. But it's important to understand this is kind of like a rolling average. So it means I take my first 14 days, I'm just estimating, I don't think this is like actually 14, but I'm taking my first, like, whatever days, I calculate my average, okay, and then I take my next one and I calculate my new average, and I take my next one, I calculate my new average, and so on and so on and so on. So it's this exponential weighted moving average but it's moving down that data frame. So it's very important that you understand that, because sometimes people get a little bit confused. We're like, oh, why do we have to do this special thing, right? Like, what's the purpose? It's because the way the formula needs to be calculated, you have to do this kind of moving component. So it's moving and it's adjusting that value by taking the latest value into consideration. Now, why would you do a weighted moving average? Well, normally you do that is because you're trying to put more emphasis on the more recent prices. So you're basically saying for older values, I don't care that much about them. I care more about the more recent ones. It's not like you're completely removing them per se, but you're not giving them as much weight. And for things like the stock market, that kind of makes sense, because let me tell you, what was popular 90 days ago could be completely different to what's popular today. And so with that reality in mind, you have to understand that the market is constantly changing. It's a very dynamic machine that is constantly taking in new information. In order for you to leverage that new information, you kind of have to just put the emphasis on the more recent. Again, that's opinions. You can find people who will gladly tell you something completely different. So, but normally you'll see a lot of indicators that will do that. They'll take kind of this exponential weighted moving average. Okay, so how do we calculate that? Well, the first thing I'm going to do is I'm actually going to just copy something so you can kind of see what's going on first. So for each data frame, what I'm doing is I'm doing a group by method. So what this will do is it's going to group it by the symbol. Now, a little bit kind of hard to understand what's going on here, but basically you can almost say it's going to kind of slice your data frame by this symbol. So it's going to have one group that's just RWR, one that's JP Morgan, and stuff like that. So if you kind of want to see that, what you can do is you can actually just say, for example, maybe you want to take the change in price column, right? So we'll just take the change in price column because, well, that's the only one we have. And what you can do is you can actually start applying some transformations to that particular, to that particular group. So I'll just, maybe I can do it like this. Kind of a better way to kind of see it. It's still a little bit hard, but you see that there are these groups, and those groups contain all the indexes, and those indexes basically is what it uses for the aggregation process, right? So if I take that and just say I did a mean, for example, what would you get? You would get a mean for each group. So the whole concept by group by is you're basically splitting your data frame into certain groups, and then what you can do is you can specify columns that you want to perform some kind of aggregation on for each group. Now, why did I do this? Well, the issue is I want to calculate the exponential weighted moving average, but I want to calculate it for each group. So I don't want that exponential weighted moving average to look at, like, for example, JP Morgan's price. I just want it to look at, Home Depot's price. So if it's part of the Home Depot group, I just want it to calculate the Home Depot group. I don't care about the JP Morgan group because those are completely different prices. So for each data frame, I group by the symbol, I select the change in price column, then I call the transform method. And then what I do is I pass through this lambda function, and I basically say, maybe this isn't the exact way to think about it, but for each row in that group, I take my exponential weighted moving average, I specify the size of my window, and in this case, it's a 14, and then I specify the aggregation. So technically you can have an exponential weighted moving standard deviation, standard error, maximum, whatever you want to call it. You have to specify that aggregation. In this case, I want an average. So once I've done that, hopefully I get something that looks relatively consistent. Again, a little bit hard to see here, but it is calculating that moving average like we would expect. So now that I have my ups and my down, I then take my up and I divide it by my down. And then from here, I can calculate my relative strength index. So I take 100 and I basically follow the formula up here. So I say 100, no, that's not right, that's plus. And I do plus, wait, maybe that isn't correct. Hold on. No, it is correct, I had it right. Apparently I had the wrong formula up there. My apologies. I apparently Don't know why I did that. Oh, I probably got the signs all mixed up. Oh, that's good. Yeah. I don't know why. I guess I got the signs mixed up. So don't reference that formula up above. I'll change that before I put it up there. But so I want to calculate my relative strength index. And then all I do is I add those columns that I calculated up here, and I add them back to my main data frame. So I have now a new column for down days. I now have a new column for up days. And now I have a new column for the RSI indicator. Now, technically, I could have added one for relative strength too, but for this purpose, we just will leave it out. And you can see, so everything's here just like we were expecting. And you can see it's calculating the RSI. So trying to think how to explain it a little bit. Yeah, I'll just leave it like that for right now. I'll get to it later. I was going to explain some stuff, but I'll keep it simple for right now. Okay, so that was the RSI indicator. Let's move on to the stochastic oscillator. So this is another momentum indicator. The idea is that momentum changes before the price changes, so it measures the level of the closing price relative to the high-low range over a period of time. So with this one, it's 100 times the closing price minus the low of the last 14 days divided by the high minus the low. So basically the range that it was in for that last 14 days. Sorry about that. Okay. So what I'm going to do here is, again, I'm going to copy my little formula. And you'll see it's actually pretty similar for the most part. I mean, nothing super crazy, but it's just kind of applying a different aggregation. So again, I still have a 14-day window that is specified by the formula itself, and in the paper they specify that as well too. And this one I do calculate, well, sorry, I make a copy again, but it does change a little bit. In my previous one, I was taking the closing price. Here, I'm going to copy my low column and then my high column. So in this case, it makes a little bit more sense to separate the two. For the one up above, maybe not so much. But again, this is just kind of making it as consistent as possible. Here, I'm still doing a group by. I'm still grouping each data frame by symbol, but here I'm specifying the low column, and here I'm specifying the high column. And I'm still doing a transformation, and I'm still specifying a lambda function. But I'm changing a tiny bit. So I'm doing a rolling function, which is basically like a rolling window. So it's a window that's going to move row by row. So it's kind of like an exponential weighted moving window, but it's a little bit different. This one, it's not doing anything super crazy with the calculation where it's including alpha or anything like that. It's just taking them in for the last 14 days for your low, and for the high, it's taking the last, for the last 14 days, it's taking the max. And then once I've got those two columns, I then just follow the information up here. So I'm going to take 100 times the closing price minus my low divided by the range between high and low. And then again, I add all of those columns back in to my particular data frame. And you can see here, so my rolling one is looking really good. So everything should be fine. Again, we'll kind of show you how to remove all the non-values at the end, but at this point, I'm just doing some calculations and keeping it hopefully as simple as possible. The William percent range is very similar to the stochastic oscillator. It is another momentum indicator. In this case, we are taking the high minus the closing and then the high minus the low. But this one is in relation to the highest price. So the previous one was in relation to the lowest price. This one is in relation to the highest price. This one can take on a range between -100 to 0. When its value is above -20, it indicates a sell signal. And when its value is below -80, it indicates a buy signal. So flip-flop. Stochastic oscillator, but flip-flop in the sense of you're comparing now to your closing price. I'm sorry, to your closing price and to the high price. Okay, so with that, very similar. In fact, you probably could have just used that same exact data we copied up above, but to give everyone their own little wonderful section, we'll just do it the same. So again, exactly the same as up above. I'm just rearranging my formula. So before it was close minus low, now it's high minus close, and then it's high minus low. And in this case, we're doing a -100 this time. And then, where is it? Hold on. Yeah, times minus 100. And again, the formula is all messed up over there. So just keep that in mind. I have to change that. This is one of my first times using latex in def. And let's just say it kind of went okay. And then sometimes it didn't go okay. So now we should have a new column for the R%. And you can see here, it looks like we're doing pretty good. So at this point, I'm still good, still happy. In our next indicator, what are we going to do next? We're going to do the MACD. So the MACD is the moving average convergence divergence. We'll go back to the paper just to be consistent. So the is a momentum indicator which compares two moving averages of prices. The first moving average is a 26-day exponential moving average, and the second is a 12-day version of the same one up above. The 26-day EMA is subtracted from the 12-day EMA, a 9-day EMA of the MACD. So the actual value that we're calculating is considered as the signal line, which serves as a threshold for the buy or sell. So when the MACD goes below the signal line, so when the MACD goes below the EMA of the 9-day, EMA of the 9-period MACD, it indicates a sell signal. And when it goes above that signal line, it indicates a buy signal. So again, another momentum indicator. This one is very similar kind of to what we were doing up above. I think it's actually a little bit easier per se. And then this one, I'm just showing you again another way of doing it. You don't technically have to copy the columns every single time. Some people prefer to do that. Some people are like, I don't care, I'll just take an existing one. But here what I'm doing is I am taking my price data frame, so I'm not making a copy. I'm grouping by the symbol like before, and I'm selecting my close like before. And then this is pretty much exactly the same as the RSI. I'm just changing my my window. So instead of being 14, it's now 26. And then for my EMA 12, it is now 12. And then to calculate my MACD, I take the result of the 12 and I subtract the result of the 26. So that's my MACD. So it's a new data frame. In fact, if you don't believe me, you can even look at it. You can take a look at your MACD. You'll see it's just a new value. And then what we do to make things all nice and fun is we then take the 9-period EMA for the MACD. And so at the end, we now have our two components. So we add the MACD to the data frame, and then we add the MACD EMA to the data frame. And then we should now have a few columns. As you can see, we have a bunch of columns now. Lots of columns. And then from here, so that's our MACD. Our next one is the price rate of change. And so with this one, we'll go back to our little paper because I trust that one more right now. The price rate of change is a technical indicator which reflects the percentage change in price between the current price and the price over the window that we consider to be the time period of observation. Is calculated as follows. So closing at time whatever minus the closing at time n periods ago divided by the closing at time n periods ago. Now, this was an interesting one because they never specified n. So I did some research, and basically what I found is I should, looks like, just do a 9-period one. So I'm going to follow that. Unless somebody can find somewhere in the paper, I mean, maybe I missed it, which is completely possible. I didn't really see where they were specifying that. Regardless, the idea is, again, we're going to kind of just do what we were doing up here. So we're not going to be making a copy or anything like that. I'm still going to be taking my closing. I'm still going to be doing my transform, and I'm still going to be doing a lambda function. The only thing that is changing is I'm using this percent change method, and then I'm specifying my window or my periods. In this case, it is 9. So I specify 9 up here, and then I add that to my main data frame, just all in one line. So again, another way of doing it if you so choose. And then you can see we now have our price rate of change. Okay, fun one, unbalanced volume. Ooh, baby, this is a good one. I'm still going to do a little bit more validation because I'm not entirely convinced that it was calculated correctly, but supposedly it is. With this one, it's a little bit more complicated because we have to do all this whole aggregation process and then add it based on certain conditions and stuff like that. So it's a little bit more complicated than the previous ones. Now, I'm still kind of doing the same thing, so I'm still grouping by symbol. I've changed my methodology. I'm now doing an apply method, and then I'm applying this function. And so this function is basically going to take each row, so each row of my data frame, because here, if you notice, I'm not selecting a column, I'm just taking that entire row. And what I'm going to do is I'm going to grab the volume column from that row, and then I'm going to grab the group, the change, basically, so the closing price. So I'm basically kind of like applying it to, what is the word, to each one. So based on that, I then initialize some values. So this is calculating my on balance volume, and then I create a list to store all those values. And then what I do is I zip these two values right here. And what I do is I loop through basically each row of that column. And then I say a very simple rule. Okay, so if the change is greater than 0, then my current on balance volume is my previous one plus the volume of that day. And then if it's not, then my current, so basically if the change is below 0, then my current on balance volume is my previous on balance volume minus J. And then finally, if it's just equal, then the current equals the previous. And then I add that new value. I'm sorry, I set my old on balance volume equal to the new one, and then I take that new one and I append it to a list. The important thing is I have to make sure that I return a Panda series, because I'm basically adding in a new column, and I need to make sure that that series has an index, and so I just use the current group index in order to do that. There's a little bit more kind of transformation we have to do, but I'll kind of show you what's supposed to come out from this. Kind of. So it's doing it, but it's a little bit different. So return the groups like we were doing. I need to add those groups to the data frame, and this is kind of the part where I'm still kind of validating stuff. I do want to make sure it's correct before I kind of start posting it. I want to create a new column, which is the on balance volume. I'm going to take my groups, I'm going to reset their index. That's the important part, because if you don't reset the index, you can't match it up. And then I'm going to drop everything. So this is the part I'm just still kind of doing some more validation before I kind of get crazy with things. And then what I do is after that, I add everything to the everything. So I think it's right. Again, this is probably the only one. I'm still going to do a little bit more, because I couldn't really find a super good answer on how to do it with groups. So I kind of just improvised and did what kind of felt was right. So we'll see. But at that point, you actually have everything you need to calculate your model, or sorry, not calculate, to build your model. So at this point, I'm going to close off the video because I think I've taken enough of people's time. We've calculated all the indicators at this point. What we're going to do in the next video is we're going to start building our model, and then we'll start getting the data prepped so that way we can feed it in. So if you have any questions at this point, feel free to put them down in the comments below, and I will try to get back to you. Otherwise, we will see you in the next video.